Hello and welcome to a new explainer vlog of Arthur Shastra Classroom. In this video, we will explain the difference between a stock and a bond. If you want to know about various types of stocks, please check our previous video, the link is in the description. So, let's get started with this video. Any company, government, cooperative society, or legal entity needs capital for expansion projects, usually known as CapEx. CapEx can involve projects that need large capital, like buying new plant or machinery to increase production facilities, establish a research and development wing for product innovation, or acquire competing companies to expand the market share of the company's products. To meet its CapEx requirements, a company or government can raise the capital by either issuing equity or debt. Equity capital is raised by issuing stocks through IPO, short for Initial Public Offering, or QIP, short for Qualified Institutional Placement. Debt capital is raised by issuing bonds. Bonds, just like stocks, are issued in primary markets through a public offering or private placements. In India, bonds are also known as debentures. Companies consider taking credit by issuing bonds when the interest rates are relatively low and attractive for them. But if high interest rates are prevailing in the growth period, the capital allocation can be met by companies primarily by issuing and listing shares in the secondary market. Stocks and bonds form the pillars of capital markets where the money is driven to the best ideas and enterprises. Free flow of capital aids innovation that translates to job creation and economic growth. Now, let us understand the difference between a stock and a bond. Although stocks and bonds are investment instruments, their risk versus reward traits differ. A stock represents partial ownership or equity in the company. When investors buy stocks, they are purchasing a slice of the company. On the other hand, bonds represent a loan from investors to the company. There is no equity involved. In other words, they will not get partial ownership of the company. They will only receive interest income known as yields. If a stock performs well in the secondary market, investors make money by selling the stock in profit. This profit is known as a capital gain. The opposite can also happen. If a stock performs poorly in the secondary market, its value goes down. At this point, if investors sell their holding, they incur a capital loss. If the price of stocks moves beyond its average trading range, it becomes volatile. The volatility of a stock's price represents its risk. The primary measure of a stock's volatility is the standard deviation. This metric reflects the average amount a stock's price has moved from its mean over a period. Some companies give dividends to their equity investors. These dividends are incentives and can either be sporadic or periodical earnings for stock investors. A bond certificate represents a loan given to the company. The company pays interest on this loan periodically to its bond or debt investors. At the end of the maturity period, the initial investment is either paid back or reinvested as per the nature of the bond. Bonds are either held till the end term of maturity or traded in the secondary market. Bond prices have an inverse relationship with the yield or interest rate. If the interest rates increase, bond prices go down. Likewise, if the interest rates decrease, bond prices go up. This risk of a bond associated with interest rate fluctuation is known as the interest rate or yield rate risk. Generally, there is an inverse relationship between the equity market and bond market performance. Rising interest rates raise the cost of capital for a company, which in turn affects the valuation of their stock. This scenario where capital and goods become expensive is known as inflation. Higher interest rates also mean that the economy is likely to slump soon, and thus bond prices also fall. Fund managers use this scenario to rebalance portfolios by shifting money from the equity market to the bond market. This process results in equity markets correcting their prices. However, when the economy grows with inflationary pressure, a rise in interest rates is offset by corporate earnings. In this scenario, investors tend to buy both bonds and stocks. To achieve optimum asset allocation, an investor needs to understand the risks involved in stocks and bonds. A middle-aged investor, who has medium risk tolerance with long-term goals, will ideally invest 65% in equity assets and 35% in the debt asset class. Some investors follow the rule of 100. As per this rule, the percentage of equity exposure of a person is the result obtained after subtracting the investor's age from 100. For example, if an investor's age is 40, the percentage of his equity exposure is 100 minus 40, which equals 60%. Until his risk tolerance or age changes, his portfolio's asset allocation ratio is 60% equity and 40% debt. We hope that after watching this video, you can understand the difference between a bond and a stock. And this video has helped you reassess your asset allocation strategies. If you like this video, please encourage our efforts and press that like button. For future updates, subscribe to our channel. Please connect by commenting and letting us know the topics of personal finance that you would like us to explain in our vlogs.